Hi, I'm Mike Gassewitz, CEO of IAIC, and welcome to another episode of In Focus. Today, we're going to have another update on our industrial sector. I'm joined by Mike Williams, our portfolio manager, who is responsible for this sector. Welcome, Mike.
Thanks, Mike.
We do this every time. Mike. It's going to confuse the listeners. Nothing we can do about it, though. Just a reminder to the listeners, in terms of the industrial sector, that's really comprised of four subsectors: transportation, manufacturing, agriculture, and tech. So I thought maybe, Mike, you could start off and talk about, what did we see in Q4 of 2022, and then maybe the year overall in across those subsectors.
Sure. Well, first of all, 2022, we were coming off a very strong 2021, both economically speaking, and the markets responded well. Going into 2022, central banks began to turn their attention to inflation and began the process of increasing rates, albeit some feel maybe a little too late and had to increase those rates at a faster pace than might be necessary if they'd started at an earlier stage in this. Against that, though, early in the year, we also had the outbreak of war in Europe, which then began to compound some of the problems of inflation, particularly those brought on by supply chain disruptions, commodity shortages, that type of thing. So against that backdrop, we began to see a lot of uncertainty, and the markets were fearful that the Fed had probably acted too strongly, too late. So the markets began to become very volatile. Now, with that, against that backdrop, our four sectors, transportation held up reasonably well. Volumes seemed to hold up and defy expectations that they were going to start falling throughout 2022. It appeared that railroads, for example, had an opportunity and the ability to pass on additional costs to their customers. On the manufacturing side, that was a bit of a mixed bag. We began to see people, consumers particularly, thinking about durable purchases. Businesses began to rejig their business plans going forward and their capital spending. They're fearful of a slowing economy and rising interest rates. Agriculture, on the other hand, as we mentioned, the outbreak of war in Europe had a tailwind to commodity prices, and rising commodity prices always result in higher farm receipts. Higher farm receipts then translate into additional spending on farm equipment, fertilizers, anything to do in the agricultural sector. Now, technology itself, that probably had the roughest ride in 2022. Companies began to readjust their structures to what they felt was the new economic reality in a coming recession. At the same time, though, we have to keep in mind that valuations in this sector are predicated on future cash flows, significantly large future cash flows. So rising interest rates have the greatest impact on those, and those were baked into the valuation. So in 2022, out of all our subsectors within the industrial space, we definitely saw more headwinds for the technology sector itself.
And on that front, I mean, we're even seeing in the headlines today about layoffs in the tech sector. And to your point on interest rates, tech, it's about future growth. You could label them growth companies, and some of those companies are growth at any cost, right? So they'll they figure the sky's the limit. They'll keep hiring, expecting that growth to come. And to your point, in terms of the interest rates, Well, that growth is further out. So if interest rates go up, for those of you who do any type of business case analysis, you know that as it, if you think about how you do a discounted cash flow, interest rate starts to going out, you start to discount those cash flows further out, and lo and behold, the value of, from at least a cash flow perspective, discounted cash flow perspective, it starts to go down, and that impacts the valuation.
That's right. And
Yeah.
compounded on top of that was the fact that in 2020, 2021, a lot of companies in the tech space had a real significant boost to
Right.
business.
Right.
And as we began to adjust to the new normal, at the same time we were fearful of a recession, they had to start dealing with some of those new economic realities.
Exactly. Okay, good stuff. So in terms of our core pick list, the list that you watch very closely, any positive standouts you look at that you go, you'd like to mention to clients?
Well, I mean, definitely if we look backwards to 2022, CNR had a great year. Volumes held up well. They managed their cost structure very well, and the stock price reflects it. And I would suggest that railroads are probably at the high end of their valuation right now. Some of the other standouts we had as far as the stocks we purchase, our agricultural picks, both John Deere and Nutrient, showed strong financial results, and that would be expected against the additional farm receipts and more spending in that sector. On the technology side that we were just talking about, one of our larger holdings is Microsoft. And Microsoft actually had a decent year as far as earnings go. But it did have a pullback in price of over 30%. So, and that's from its peak, keeping in mind that it had a really decent run up to that point. However, 30% pullback, while it sounds very significant, was probably on the it fared better than the rest of the tech sector. Some large names, some household names we saw pulled back 65, 70, 75%.
All right.
Now, as far as going forward, they are starting to adjust to the new reality themselves, and we can see that they just announced some layoffs. So
Right.
if I look at the standouts, I look at some positives and some negatives. And that kind of sets the ground for us going forward into 2023.
So let's talk about 2023 then. I mean, obviously, we never ask any of you guys to necessarily predict everything that's going to happen, but thoughts in terms, again, between the subsectors, sectors will look more, you believe will look more favorable in 2023.
Yeah, well, that's really going to be quite dependent upon where the broader economy goes and some of those other factors. Of course, the two things that we really watch that are interconnected: inflation, interest rates, and thus, are we heading into a recession? If we're going to see a recession, is it going to be a hard landing or a soft landing? So those things all factor into our thinking at a higher level, we call it the 30,000-foot level, and then filter down into what we think about the sectors and individual companies within it. But against that backdrop, I'd say, we've come off a very good year for railroads, transportation, agriculture. If we see a pullback in commodity prices, we might see some softening in that sector. Again, railroads were priced as though we were basically running on all 8 cylinders, and any economic slowdown could have an impact there, particularly with the high valuations that they're currently at. We're beginning to see that. Q4 was very strong for our Canadian railways. Our pick in the US, Union Pacific, actually saw its results begin to deteriorate due to economic conditions. So we're preaching a little bit of caution in those areas. We had a strong 2022. What goes up, the fastest is where you have to preach the greatest caution. On the other side of the coin, if interest rates begin to level out, or even turn the other way, but even level out, once the Bank of Canada, once the Federal Reserve once central banks around the world begin to see inflation coming back to within their targets, we should see them turn that dial down a little bit, become more accommodative. And in that case, the sector that got beat up the worst may fare the best, that being technology. So there's going to be a time, is it right now? Probably not quite yet, but there will be a time to turn the dial back and maybe add additional exposure to technology.
Right.
So we're cautious about those sectors or those stocks that have done really well up to this point, and we're a little bit more optimistic on those that have been beaten up. And
Right.
almost quote Warren Buffett, when people are fearful, that's the time to get greedy. And there is going to be a time in the tech sector to do that. So we are looking for opportunities, but we're monitoring those broader economic conditions to see when the time is right to kind of move those dials a little bit.
Makes sense. Mike, thank you for this. Appreciate you joining us today.
Okay, thanks a lot.
And folks, as always, if you have any questions on anything you heard or really anything about your portfolio, don't hesitate to reach out to your portfolio manager here at IAIC or talk to your accounting firm partner. Thanks again. Have a great day.